Welcome to this week's Q&A. We've got a great question from one of our viewers from China today. And this gentleman, who's an Aussie expat, says he has 2 investment properties he's had running for quite a while and has built up quite a handy tax loss. So he's looking to repay those loans, and he wants to know about negative gearing and how that works, because his idea is to repay the loans and basically then create new loans against those properties when he needs to ramp up his negative gearing once again, so he can offset that against income that is deriving from those properties, or perhaps those properties plus another property or other forms of income when he needs to. So effectively he's asking, can I keep this negative gearing going on forever as I choose, by just turning the tap on and off at will? So the easy answer to that is no, you can't, because people often forget that it is the purpose of the loan that determines tax deductibility of the interest. So if you initially go and buy an investment property, and let's say you gear that to 85% of its value, then that is a loan that's taken out with the purpose of creating assessable income, whether you're an Australian tax resident or a non-resident. So the interest is tax deductible. However, if you then repay that loan, then that loan is repaid. And if you then go and seek to create a new loan, what's the purpose of that loan going to be? And that's where people fail to, I suppose, remember that nexus, because people often think that just by creating a loan against a property that's rented out, regardless of what they use the money for, that's immediately going to create a tax deduction via their interest payments. And that's actually not the case. So very important when you look at your long-term planning to make sure that you do this correctly. And there are ways via offset accounts and other measures that we can actually achieve an outcome that this gentleman's wanting, but doing it properly, so that you maintain the integrity of your original loan and therefore the deductibility of the interest on that. There are other things to consider, obviously, because human nature being what it is, it's sometimes a little arrogant of us to consider the fact or think that we can always obtain a loan. What if you repay your loan and then down the track you say, oh gosh, I need a tax deduction again, I'll just get a new loan. And the bank says, no, you can't have one. You may have lost your job, you may have been disabled, who knows what could happen in the future. So as I always say to people, be careful of what you think, and before you act, make sure you get some advice. Otherwise you could really, I suppose, shoot yourself in the foot and create a burden for yourself long term that you never anticipated would happen. So before you pay out any tax deductible loans, make sure you get some good advice, speak to your accountant or your advisor, and by all means reach out to us. We can assist you with all of these matters very readily. And if you like what you see, subscribe to our YouTube channel and click like, and I'll see you again next week at our next Q&A. I'm Andrew Unterweger from Wise Guru. All the very best to all the Aussie expats around the world and all of our Australian viewers back home.